The big question is it a bounce before it rolls over and we go into something like 2022, another small bear market or larger than that? Or is the market going to bounce, stabilize, and actually want to build a launch pad to go even higher?
The Financial Survival Network. Now more than ever. The Financial Survival Network.
And welcome. You are listening to and watching the Financial Survival Network. I'm your host, Kerry Lutz. Hey, we're already at March 19th. March is ticking away. Market has been very dicey lately. Gold, amazing. Oil, down. Dollar, down. Interest rates, maybe they're going down too. But we want to talk with the technicaltraders.com, Chris Vermeullen. Chris, great to connect with you again. So Trump is in office. The stock market is having some indigestion, isn't it?
No doubt. Yeah. And thanks for having me back on the show, Kerry. Yeah. The markets are wild for sure. We've got Trump throwing landmines out every day. You don't know what he's going to say or do. He's making it difficult for, I think, short-term traders. But overall, I mean, the overall trend of the markets, I believe, are still really giant tides in the market. And news is usually short-term blips and dips on the market. And you're right, it has been very volatile. We've seen a lot of selling in the equities markets. We're seeing quite a bit of damage being done on a technical standpoint, a lot of momentum to the downside, a lot of heavy selling volume, a lot of fear. And stocks, though they are beat up and they're a little oversold, and just based on the charts and some cycle analysis, it looks like the markets are primed and ready to bounce for maybe 3 or 4 weeks. And then the big question is it a bounce before it rolls over and we go into something like 2022, another small bear market or larger than that? Or is the market going to bounce, stabilize, and actually want to build a launch pad to go even higher? So we really got to take it one bar at a time. It depends what various assets are doing. But right now, as you mentioned, oil is down. It's looking pretty weak. That's not a good economic indicator. Gold is skyrocketing, hitting all-time highs, telling us the world is nervous and fearful, and they want to get out of the financial system because they don't trust banks, they don't trust the government, and they want hold their money in a physical asset. So there's a lot of chaos kind of in the cards. When you read the tarot cards of the charts, there's nervousness.
Yeah, well, my portfolio not doing so great, but it's been more than offset by the appreciation in gold, 30-30 gold. Uh, what can you say about it? And now even silver is starting to react. It's approaching $34. Uh, Tell us your forecast moving ahead. We can have a pullback on gold or because it's really gone a little bit, it's gone too much too soon.
Yeah, I mean it's in a pretty major super cycle in a bullish phase. We had a target at 3,050 was our next measured move target, saying that's where gold should run to for that first level. And based on that, we're pretty much at that level. 3050, 3060 is that area. I think gold still though has a lot of upward momentum. If gold really was to take off and break through this level, then it's going to about 3,200. So we need to see how it's going to move at this kind of 3,050 area. I have a feeling we're going to see a little bit of a pause, which is actually a good thing. If it pauses here based on Fibonacci theory and technical analysis, that means the momentum triggers and the momentum levels are accurate. And if it pauses at this level, that means it wants to go up and hit that 100% measured move, which is around $3,200 dollars per ounce for gold. So you definitely don't want to be picking a top in gold. Gold, the precious metal space has been the sweet spot for the last couple of years. It continues to be the sweet space, and it's picking up momentum, telling us I think we're actually getting closer and closer to an economic kind of crisis and a bear market in equities. And gold will get pulled down to some extent when that happens. But until then, gold really is the lowest volatility, the highest probability of making more money going forward. If you don't want to be stepping into the ring with, stock massive pops and drops and presidential kind of news shaking things
Mhm.
up.
All right. So, hey, do you have an opinion on silver?
Yeah, I mean silver's similar-ish. I mean it's breaking out, it's moving higher. It's trying to break this 35 range. I do think we could see silver potentially squeeze and run up a little bit higher, all the way to about 46 or $47. So percentage wise, there's still a half decent move in silver, but the overall chart pattern for it has a pattern that's unfolding that I call three surges to a high. And it usually ends very abruptly with a strong reversal. And right now the trend is up. And so I do think when the economy potentially turns a corner and the momentum in the precious metal space stalls out, I think silver is going to have a pretty big haircut. But money's flowing into this space because it's nervous. I do prefer gold myself because it's at all-time highs. There's no overhead resistance, um, and it's more stable. Silver can fall very quickly, so it's not something you want to. I wouldn't want to dump a ton of money in because you can wipe out 5, 10, 15% of value in a couple of trading sessions. Whereas gold, a big down day on gold is like 1, 2%. You need a few of those back to back to do some real
Mhm.
damage to a portfolio. So that's why gold tends to do very well. It's kind of the global barometer of fear. It's the most stable way to store your money outside of like stocks and real estate and silver and miners. They're all very volatile. You can put large stores of money into gold and not have to sweat worrying about it, losing 20% in a week.
Yeah, that's true. But with volatility comes much more potential for upsized gains, right?
For sure. And that really comes down to the type of trader or investor and where they are in their life cycle, right? Like my focus is on, and who I help the most with are people generally 50 plus, who have a lot of wealth and they don't want to give it back. They're not swinging for the fences. They're not looking for big volatility. In fact, they're looking for capital preservation. How can they keep making money no matter what happens in the market? Versus trying to make a whole bunch and take a lot of risks. So obviously there's two sides of the camp. I'm the side of people who love gold, who love currency, who love moving in on waves in full asset classes like the stock indexes or bonds when they're moving. Not people who want to go into crypto and trade, individual stocks and try to play whatever's in the news. So I definitely cater to the low volatility but consistent returns for large amounts of money versus volatile bunch of small trades, swinging for the fences for some, a bunch of grand slams and stuff. That's just not the style or focus that I do.
All right. So, yeah, uh, understand what you're saying there. So, how does this affect gold and the dollar?
Yeah, we've definitely seen the dollar get pretty beat up with Trump and the tariff talks. Could slow the economy, it could create inflation. There's all kinds of different people saying different things. The dollar's definitely been beaten up. I think most of the tariff news has now been kind of worked into the dollar. It's fallen down to about this 103, 104 range, which is when you look back on a long-term chart and go back several years, it's the middle high volume area where it should find support. It's in the middle of a range from really 2023 all the way to 2025. And so the dollar has fallen. I think it's worked its way through the tariff news, and now it's trying to find stability. And I think if the economy still weakens, I think we're going to see the dollar perform very well. In a long-term trend, when you zoom back many, many years, it is a noisy chart, the dollar index, but it is moving up and to the right, a series of higher lows, series of higher highs. And I think we could see a pretty big move. It's at 103 right now. I think it could go to 116, potentially 120. So it's not huge percentage wise, but it's a nice slow moving asset class. And it usually does well during chaos and financial uncertainty.
All right. Hey, so, you know, interest rates, they've been heading down. The administration seems to be thrilled about it, but the fact is that could be indicative of a recession, couldn't it?
Yeah, I think so. I mean, the short term, daily chart of, the 10-year note, it looks a little bearish. It looks like it's in a downtrend right now. It's got a little bear flag. It looks like it could want to fall a little bit actually and have another leg down, which means bonds could go up for a little bit. But in the grand scheme of things, I still think we're going to see yields continue to hold up and bonds are going to struggle. I think when you look at the big picture of the 10-year note, it's kind of got a long-term kind of big topping phase. When you look at the long-term chart of TLT, which is the long-term treasury bond, it has a long-term bottom. It looks like it's trying to form a bottom, but it doesn't mean they've fully bottomed and they're about to, the dollar's not going to, or sorry, bonds are not going to just take off and rally. And I don't think interest rates are just going to fall out of bed and drop. So I do think they are kind of a painful play. A lot of people have been moving into bonds for the last couple of years saying, hey, bonds have bottomed. And while bonds may have bottomed, I'm not really expecting them to rally and generate huge returns anytime soon. So it's kind of dead money. I like to get into something when it has bottomed and it has started an uptrend, meaning it's going to consistently
Mhm.
be going higher. And right now, bonds are still in a bottoming, choppy, noisy environment that wastes a lot of time. And as you know, the only thing more valuable than money, more or less, is time. And that's the one thing that I avoid is I don't hold assets going sideways because it's a waste of time. I move our money to an asset class that is generating returns and doesn't have any downside risk or very little downside risk. And so the bond market, we're on the sidelines. We're not touching the bond market right now until I think we see them starting a new rally to the upside. And then I think there's going to be a great opportunity to hold bonds. I think they could become one of the best performers potentially the second half of this year and into 2026. So I'm not ruling them out. I'm just saying they're kind of a waste of time right now and they're a waste of risk. You don't need to risk your money for something going sideways. Wait until it's in an uptrend, and there could be some
Right.
pretty decent returns there.
Okay. So, going to be interesting to see what happens here.
Mhm.
What's your personal opinion here?
Well, I think my outlook, I think this year we're going to see the equities market top out. I think we're going to see the economy have a big reset. I think oil is going to break down in a very big way, and I think shorting or playing an inverse ETF on the energy sector is actually going to be a very interesting play. There's huge divergence. Oil has been going down for the past couple of years. Energy stock prices have been going up for the past couple of years, and there's this very big, to me, bearish divergence. And I think oil is on the cusp of breaking down and falling to potentially 55 or $50 a barrel. And energy stocks are going to get hit. Couple that with a bear market, which naturally pulls stocks down. I think we could see like a 40 to 60% correction in energy stocks in the energy sector. ERY is kind of like an inverse 2x inverse play. So I think there's going to be some amazing opportunity to the downside. The markets have not topped yet. They're not in a downtrend. So we're not picking a top, but we're mentally prepared. We have some trades in the wings that we're watching and tracking so we can take advantage of falling markets through inverse ETFs or move to the dollar, potentially bonds. So I think this year is going to be the year that changes a lot of people's lives in terms of financial things turn down. Real estate bottoms, I think, going to fall out there later this year. And people just need to be aware. It's about capital preservation more so, and being able to just etch out some returns versus trying to make money and potentially losing 30 to 50% of your account. So this is going to be a
So,
huge year, life changing for anyone in retirement who doesn't take action and doesn't protect themselves. The buy and hold strategy is pretty much a ticking time bomb for anybody 45 plus at this
mhm.
point, because you could waste 5 to 10 years with this next downturn before we potentially even hit new highs. And that's kind of the whole reason why I've been teaching and showing this strategy I called asset revesting, which is a book I published last year. Really, my whole vision and mission is like, how many people can I save in retirement from the next crisis that's coming? And being prepared is the first step.
So when is it coming here, though? I mean, we've been waiting for it for a dozen years already, Chris.
Yeah, well, I mean, that's the thing with technical analysis is, I mean, it's not about me saying, hey, it's going to happen, on a specific date or year. We follow price, and if the price just keeps going up, even though I've been bearish for a couple of years, several years, but we're still long the markets, we're still riding the trends up. You have to differentiate between what you think you feel and what the markets are actually doing. So while I prepare everybody, prepare there could be chaos and know you need a plan. We're not going to like do this until the actual trend changes, and we're going to stay long until then. And it doesn't really matter when it happens because we're riding these trends higher, generating the returns. And when finally things do turn around, which I do think will be this year,
Mhm.
then we've already got a game plan. There is no shock and awe. It's not going to catch us off guard. We'll be like, perfect. Things are breaking down. We're be rotating our capital from one asset class to another. But if you're looking for a date, nobody can really do it very well. I mean, it's if you
Okay.
do, it's you kind of is a fluke, but it's very difficult to time economic downturns.
All right. So
Yeah.
when we talk again next March 19th in 2026, where do you think gold's going to be?
2026, I would think gold. I think gold could be probably back down around. I would say maybe $2,500 an ounce.
Hmm.
I think it will have bottomed. I think it will be moving up or building a base. Maybe higher than that, maybe 26, 2,700. And then once it starts out of that base, then I think it's off into the 5, 7, 9,000 range. Who knows where it's going to go? It depends on the chart pattern it forms, but I'm definitely bullish on precious metals long term. But over the next year, I'm not really that bullish on it. Most of the run has already happened, I believe. And now it's kind of wait for a pause and reset. If you don't own it and you're not in it, I wouldn't really be buying it here because I think there's going to be a discounted price here soon for potentially 6, 8, 9 months to pick it
Yeah,
up at a better price.
that wouldn't be unusual at all. All right. So just tell us where we find you, Chris, how we connect with you on the web.
Yeah, sure. If you can see my charts analysis and watch me kind of go through the markets on my YouTube channel, just search up The Technical Traders, or you can go to my website, thetechnicaltraders.com. And I share my newsletter. I invest my own capital and I just share exactly what I'm doing, what I'm thinking and seeing in the charts, share my portfolio and allocations, send out trade alerts anytime I do something. And my book, Asset Revesting, it's on our website or on Amazon if you're interested in learning about holding only assets going up and having 5 to 12 trades a year using ETFs.
Excellent. Hey, if you've got any questions for Chris, myself, kl@kerrylutz.com is the email address. And you'll find a link to Chris's site in the show notes to this interview on financialsurvivalnetwork.com. While you're there, we just ask that you sign up for the free newsletter. Over 70,000, close to 75,000 of you have already over the years, and it goes out generally weekly. Chris, we will talk to you again. Be well.
Thanks, Kerry. You too.